Now the topic before us is understanding the financial account in balance of payments. We have already learnt that there are three components in balance of payments: current account, capital account and financial account. And in the case of capital current account, we record the transactions pertaining to export and import of goods and services, unilateral transfers paid and received, and investment income paid and received. In the current account, we record the transactions pertaining to acquisition and disposal of non-produced and non-financial assets and capital transfers. Now, in the case of financial account, we record the transactions pertaining to foreign portfolio investment and borrowing and lending from and to foreign institutions. Financial account records the transactions that involves financial assets and liabilities that take place between the residents and non-residents. When we are talking about foreign portfolio investment, it means purchase and sale of financial assets such as stocks, mutual funds, and other securities by investors from other countries. By adopting FPI route, the foreign investors cannot take the ownership rights of the company. Foreign investors, in case of FPI, adopt a passive mode and they do not take part in the decision making of the company. We also, in the financial account, we also record the transactions pertaining to borrowing from foreign entities, and we also record the transactions pertaining to lending to foreign entities. And if there is repayment of loan by the foreigners, or if we repay the loan to the foreigners, there are also taken into account in the financial account. There is also an official reserve account in the financial account, and where we record the transactions pertaining to foreign exchange reserves, gold reserves, special drawing rights and reserve position in IMF. If the country imports more than it exports, official reserve account can be used to bridge the. Now the topic before us is current account versus balance of trade. We will now understand the difference between current account and balance of trade. In case of current account, we know that there are four components. What first is visible items, then come invisible items, then come unilateral transfers, and the fourth is income from investments. These are the four components of current account. Current account itself is one of the components of balance of payments. So when we are talking, we are here to understand the difference between current account and balance of trade. The balance of trade is only concerned with these two: visible items and invisible items. Visible items means goods which are can be seen, touched and measured. So these are called visible items. Invisible items means services which cannot be seen, touched, measured, and the examples of the same are shipping, banking, insurance, transportation, etc. Balance of trade is the difference between exports and imports. That is, exports minus imports is balance of trade, the value of exports minus value of imports. Here we are talking about exports of the country as a whole, imports of the country as a whole, all the exports which take place between the country and the rest of the world. So here is a brief overview of this. All is a brief overview of current account. As already told earlier that in the case of current account, we record transactions on the debit side and on the credit side. All the transactions because of which there is inflow of foreign exchange, they are recorded on credit side. If there is inflow of foreign exchange, all those transactions on account of which there is outflow of foreign exchange, they are recorded on debit side. When we export goods or export services, we receive foreign exchange, so they are recorded on debit side. When we import goods and services, there is outflow of foreign exchange, so they are recorded on debit side. When we make unilateral transfers, that is, there are one-time transfers also, that is, we may be giving aid to other countries on humanitarian ground. So these are one-time transfers for which no return is expected. We may be providing food, medicines to the rest of the world in case there is any humanitarian problem in any country of the world. So these are one-time transfers, unilateral transfers, for which nothing is expected in return. In the same way, when we receive unilateral transfers from the rest of the world on humanitarian ground, etc., then they are recorded on debit side because there is outflow of foreign exchange. If we give, it is unilateral transfer. When we give unilateral transfers, there is outflow. When we receive unilateral transfers from abroad, it is recorded on the credit side because foreign exchange comes into our country. When we receive income on investments in the shape of dividend, interest, etc., there is inflow, so they are recorded on credit side. And if we make payments or the foreigners receive payments for their investments in the shape of interest, dividend, profit, then it is recorded on debit side because there is outflow. So here, this is whole is current account. And if we are to talk about balance of trade is only concerned with only these two items. This is balance of trade, the difference between exports and imports. Now we will have an overview of current difference between current account and balance of trade. Current account is an account or one of the components of balance of payments where we record exports and imports of goods and services, unilateral transfers paid and received, and investment income received and paid. And all these transactions are recorded when they take place between the residents of a country and the rest of the world. On the other hand, balance of trade is the difference between a country's exports and imports of goods and services. If we say that balance of trade is only concerned only with export and import of goods, it is the narrower definition of balance of trade. It If we say that balance of trade is only concerned with goods, then it may also be called balance of visible trade. If we say that balance of trade is concerned only with services, it will be called as balance of invisible trade. So when we are talking about balance of trade, we will be taking into account both goods and services because this is the broader aspect. We cannot ignore the role of services in export and import of the country. Services play an important role in any economy. So when we are talking about balance of trade, we should have a broad overview and should also include services in the case of balance of trade. Now, what are the components of balance of trade? We have already discussed that visible items, invisible items, investment income and unilateral transfers are the components of balance of trade. And in the case of balance of trade, the components are visible goods, or we can simply say goods and services only. we do not take into account unilateral transfers and investment income in the case of balance of trade. We are only concerned with goods and services in case of balance of trade. Now settlement. Current account deficit cannot be financed by balance of trade. What it means? When we record all these transactions, suppose it is 1000, it is 500, it is 200, it is 150, it is 100, it is 90, it is say 700, it is say 600. And when we make total of the debit side and credit side, what it means? What comes? It comes 2000, 1000, 700, 200 and 100. Zero, zero, no, 7, 1340. Okay, you can see that here inflow is less, whereas outflow is more. So here is deficit of 660. It is deficit minus 660. The figures are in negative. Here the difference current account is deficit. So whether this deficit can be filled by export of goods, difference between export and whether if we do exports, if we are earning more from exports as compared to say if the figures are more in exports, whether it can be met, this deficit can be met by here balance of trade. No, because we have already, this is the figure which is arrived at only by totaling debit and credit side. So here the deficit, if any, the current account cannot be met by balance of trade, because balance of trade it itself a part of current account. But balance of trade, if there is deficit in balance of trade, it may be met, or we can say that other parts of current account can play a supportive role in mitigating the overall impact of deficit in BOT can be partially offset by other parts of the current account. What it means? It means that suppose there is a deficit in balance of trade. What it means? It means that if imports are more than exports, suppose this is the situation, what happens? We will have to pay. So these two parts, other parts of the current account can play a supportive role in reducing the impact of of current deficit of balance of trade. Suppose there is difference of say in export and import, there is difference of say 200. Suppose we assume that there are negative figures, imports are more as compared to exports. So these two items, unilateral transfers and income, can play some role in reducing this negative figure to some extent. But we cannot say that all of the negative impact of balance of trade will be absorbed by these two items, unilateral transfers and income. No, they can play only some role, not completely wipe out the impact of negative balance of trade. We will again read, other parts of current account can play a supportive role in mitigating the overall impact of deficit in balance of trade. Overall impact of the deficit by by partially offsetting the same. Now the topic before us is trade winds shifting, understanding equilibrium, surplus and deficit in balance of trade. Before understanding what is balance of trade, we will have a brief overview of balance of payment. We have already learnt that balance of payment is a systematic record of all the economic transactions which take place between the residents of a country and the rest of the world during a specific period. That is, every country exports something from other countries in the shape of goods and services, and it also imports some goods and services from the rest of the world. We sometimes give aid on humanitarian ground to the rest of the world, and sometimes we receive the same. Sometimes we receive investments from the rest of the world, and sometimes we make investments. Sometimes we borrow from the rest of the world, and we also provide loans to some foreign countries. So all these economic transactions are recorded in balance of payments. You have already learned that balance of payments consists of three components. That is, balance of payment has three components, and there's that are current account, capital account and financial account. Now here we are discuss about balance of trade. Now this current account, in the current account of balance of payment, we discuss export and import of goods, export and import of services, unilateral transfers. Unilateral transfers are one-time transfers. That is, we do not get anything in return. When we give aid to other countries on humanitarian ground, we do not receive anything in return. Then how universal transfers are recorded in balance of payment? When we give food, medicines on humanitarian ground, an estimation of the value of food or medicines is made and recorded in current account of balance of payment. And then income from investment. We may have made some investments in foreign countries, and we may be receiving income in the shape of, say, rent, dividend, profit, and at the same time foreigners might have invested in our country, and they may be receiving payment in respect of their investments in the shape of dividend. So all these transactions are recorded here, income from investments. So now we are discussing about balance of payment. These two, export and import of goods and export and import of services, are related with the concept of balance of trade. That is, balance of trade is the difference between export and import. This is balance of trade. The value of goods and services which are imported minus the value of goods and services which are imported from the rest of the world. This is BOT. This is the broader definition of balance of trade. There is also a narrow definition of balance of trade in which only export of goods and import of goods is taken into account. This is the narrower definition. Now we will read what is written. Balance of trade refers to the difference in value between a country's total exports and imports of both goods and services over a specific period, usually year. That is, whatever we export during 1 year to the rest of the world regarding goods and services, and whatever we import from the rest of the world, the difference between the two is known as balance of trade. This is the traditional and broader definition. There is also, as already discussed, there is also a narrower definition which takes into account only the exports and imports of goods only. The narrower definition may be used in specific contexts where our focus is only on tangible goods. Tangible goods means the goods which can be seen, touched. Goods are always also known as visible items. That is, they can be seen, touched, and measured. Balance of trade on goods is also known as balance of visible trade. Visible means all those items which can be seen, touched, or measured. So, narrower definition of balance of trade is also known as balance of visible trade, BOVT, or merchandise balance. Merchandise means goods balance. So here, this is the formula for calculation of balance of trade: exports minus imports. If we take into consideration the narrower definition of balance of trade, then it is written balance of trade goods only is equal to export of goods minus import of goods. It can also be written as balance of visible trade. Here we will only take into account the export and import of goods only. Now, here is an example to understand the balance of trade. Suppose a country is exporting goods and services worth $100 billion, and at the same time it is importing goods and services to the tune of $90 billion. What is the balance of trade? As per broader definition, balance of trade is exports, which is here 100 billion, minus minus $90 billion. So what is balance? $10 billion. So balance of trade is $10 billion. Here it is surplus because exports are more than imports. If we take other export of goods, here is only BOT goods. Here exports are 80. What is import? 85. Then what is balance? It is minus 5 billion. Here it is deficit balance of trade because imports are more than exports. Now, balance of trade may be trade surplus, trade deficit, or trade balance. We can also call it positive balance of trade. This is deficit balance of trade, and this is zero balance of trade. We will understand this concept with the help of example. Suppose exports are 100 US dollars and imports are 80 US dollars. We are not taking here the example in billions. To keep the example simple, we are simply taking it as US dollars. So here, what is balance of trade? Balance of trade is exports minus imports. So 100 minus 80 is equal to 20. So 20 is the balance of trade. So here, what is exports are more than imports. So when exports are more than imports, it is trade surplus. That is, the country is having trade surplus, or we can also call it positive balance of trade when exports are more than imports. Here in the second example, here exports are less as compared to imports. So 80 minus 100, exports are to be taken first and then we have to take imports. 80 minus 20, it becomes minus 20. Here exports are less than imports. So it is trade deficit position. The country is having trade deficit because it's the value of its imports is more as compared to exports. It is also known as negative balance of trade. So here 100 is equal to 100. 100 minus 100 is equal to 0. Exports are equal to imports. So here what is the position? It is trade balance. Trade balance or zero BOT occurs when exports are equal to imports. But in the real world, this situation of trade balance, that is zero BOT, zero balance of trade, rarely occurs. When we are talking about when we are talking about trade balance, it means there is an approximate balance that exports and imports are roughly equal to each other. If we say that exports are 100 and imports are 99.5, so here there is negligible difference between the two. We are not taking the figures in billions, we are taking only a small figure. So when will be talking in say billions, we will be saying it is 99.9. So here the difference between exports and exports is negligible. So in case of trade balance, when the difference between exports and imports is negligible, it is regarded as trade balance. In the real world, exports and imports are rarely equal to each other, and even if they are equal to each other, this trend cannot remain continue for a long term. USA is having trade deficit for the last so many years. Why? Because the currency of USA, which is dollar, is very strong. So the people of the rest of the world do not buy the do not import the goods from USA because the value of the currency is more and the prices are the goods are more. Further, the domestic saving rate of in USA is further USA in USA many of the industries get their products manufactured from other countries because the cost is less. So after manufacturing, they import those goods and sell those in USA. So due to these reasons, there is trade deficit in USA. When we are talking about balance of trade, it must be remembered that trade balance of trade is just a one a picture of the whole economic picture of the economy. Was only one side. When we are talking about the economic position of the country, we will have to take in take into account many other things such as exchange rate, investment attractiveness, etc. We hope you might have understood the concept of balance of trade in very simple language. Now the topic before us is understanding the differences between balance of payment and balance of trade. Here we are to discuss the difference between balance of payment and balance of trade. Firstly, we should understand what is balance of payment. In this world, there are a large number of countries. A country may be having many things which it may be having in abundance. So it will be exporting those goods to the rest of the world. Some things a country may be having in shortage, so it will be importing those goods from the rest of the world. In the same way, a country may be exporting certain services to the rest of the world, and it may also be importing or receiving certain services from the rest of the world, such as banking, insurance, shipping, transportation, etc. Sometimes we provide aid to the rest of the world on humanitarian ground in the form of, say, money, food, medicines. At times when there are natural disasters, say lot of floods or other reasons, we may be receiving foreign aid from the rest of the country. Then we are maybe having certain investments in foreign countries, and from them we may be receiving certain incomes in the form of income, dividend, profit, interest. And at the same time, foreign investors may be having certain investments in our country, and they may be receiving payment from us in the form of dividend, interest, profit. Sometimes we borrow loan from the rest of the world or foreign institutions, and sometimes we also provide loans to the rest of the world. Sometimes we make investments abroad, and sometimes they make investments in our country. So BOP is a systematic record of all the economic transactions which take place between the residents of a country and the rest of the world. We have already discussed in detail what is the meaning of balance of payment. So balance of payment is a very big concept. As already discussed, balance of payment has is three components. First is current account, capital account. Although I am using A/C in place of account, you are to write completely. And the third is financial account. In the current account, we take into or record the transactions which pertain to export and import of goods. Then we record in current account the transactions related to export and import of services. Then unilateral transfers received or paid, received and paid. We may be receiving certain investments, we will be also taking note of the same, and what in unilateral transfer we have paid, we will be also taking the note of the same. Then income from investments paid and received. In the capital account, we take into account the transactions related to acquiring or disposal of non-produced, non-financial assets and capital transfers. And in the case of financial account, we record transactions pertaining to foreign portfolio investment, and there is also official reserve account. We will discuss all this in detail. Now we concentrate on BOT. Here we have discussed we have an overview of balance of payment. So when we are talking about balance of trade, these two items, export and import of goods and services, pertains to balance of trade. Balance of trade means the difference between the value of exports of goods and services and import of goods and services. So from this overview, you can see that balance of payment is a very bigger concept, and balance of trade is only related to is a very narrow concept, and as compared to BOP, and as it pertains to only it is only the difference between export and import. Further, balance of payment has three components: current account, capital account, and financial account, whereas balance of trade is only a sub-component of balance of payment. We will discuss each of all the differences between BOP and BOT in detail. Let us see. The balance of payment is a systematic record of all economic transactions which take place between the residents of one country and the rest of the world over a specific period. We have already discussed in detail the meaning of residents. Residents means individual residents, businesses, and government and its organizations within the jurisdiction of the country. In the case of residents, as discussed in the definition of balance of payment, does not include diplomatic staff, foreign military personnel, migrant workers, etc. On the other hand, balance of trade is only the difference between the value of a country's exports and imports. The components of BOP are balance of trade, unilateral transfers, income, investments, loans. Balance of trade is only a part of BOP under the head current account. Equation: balance of payment is the sum of current account, capital account, and financial account because it has three components. On the other hand, balance of trade is equal to exports minus imports, exports of goods and services and imports of goods and services. Surplus balance of payment occurs when there is more inflow of foreign exchange than the outflow of foreign exchange total. When we discuss balance of payment, we record all the items. Here we record debit items, here we record credit items, and after listing all the items, such as if there is credit, it is a positive. When there is outflow of foreign exchange, it is recorded on the debit side. All the items which result into inflow of foreign exchange are recorded on credit side, and all the transactions which result into outflow are recorded on the debit side, and we make a total of the debit side and credit side. And if credit side is more than debit, it is surplus BOP, and if credit is less than debit, that is inflow is less, outflow is more, then it is deficit BOP, deficit balance of payment. BOT is surplus when exports exceed imports, and balance of trade is deficit if exports are less and imports are more. Significance: balance of payment is a wider concept. It provides a broad picture of the country's international economic activity, whether exports are more in comparison to imports. It will also provide what is the position with regard to unilateral transfers, whether we are receiving more in the form of unilateral transfers or we are paying more in the form of unilateral transfers, whether income received from investments is more or we are making more payment to the foreigners in the form of income on investments. And we will also understand whether capital transfers are more or less. We will have all this. So balance whether investments we are making abroad are more or we are receiving more investments, whether the outflow of foreign exchange in the form of investments is more, whether we are receiving more loans or whether we are providing loans, whether we are net debtor or net creditor. So all these points are shown by the balance of payments. So it is a wider concept. On the other hand, balance of trade is only a narrow concept. It is only concerned with export and import of goods and services. So at the last, we can say that balance of payment is a broader concept and it also includes balance of trade in addition to other items. Balance of trade is a significant component. Significant means important component of balance of payment. But balance of payment captures additional economic activities beyond just the import and export of goods and services. It means that in the case of balance of payment, we not only record transactions pertaining to export and import, but we also record the transactions pertaining to other items such as unilateral transfers, incomes, investment received from abroad, loans paid or loans received, etc. Thanks for watching. If you like our course, please spare some time to give a star rating to our course.